All right, guys, how are you doing? My Clover people, my Clove Tards, my. Let me know if there's any other nicknames you guys want me to call you guys. All right, so I feel upset because I got some data about 4 days ago, and I just haven't had time to talk to you guys about it. It's actually really important. Economic indicators, and you know they essentially have an impact on the stock market. I pretty much just changed the whole Discord. I added so many components into it, so many different AIs. I just released the Brain Machine, um, our AI here that helps find the values of stocks. Like for example, this gentleman here, uh, he put our ticker symbol AL DCF Clove, and it released a price target of $3.34. Still um, undervalued, and as soon as it transcends to that stock price, it'll reintegrate and recalibrate a new beta. Um, in layman's terms, it'll reissue another price target. Okay, so we do this because it's very difficult. So I created this particular DCF here, where we're able to essentially get, it's powered by our stock trades, and you can search any stock you want. Like for example, you can go ahead and look up, let's say, PayPal, and you'll get a stock price of 97. Sorry, a DCF of 97, but a stock price of it's trading at 92. But anywho, because of this, we now offer a 3-day free trial. Before we didn't do that, and yeah, if you guys are interested, it'll be linked down below. But let's talk about some serious things. If you guys, you guys can share it on the StockWits and Reddit. I'm a little busy, so after this, I got to get going. But this is actually really important. So this is going to be a 3-part series. Part 1 and Part 2 are going to be more economic indicators, and for people that don't understand why, like how is this related to Clover Health? Why are we talking about this and not Clover Health? Well, Clover Health is in the NASDAQ. The NASDAQ is in the stock market exchange. The stock market exchange is governed by economics. Economics is governed by supply and demand, and supply and demand is governed by essentially how the economy and global economy functions. And if one is out of whack, it'll ultimately feed down to your portfolios. So that's pretty much basically the simplistic forms to talk about this. But if we go to our exclusive daily briefing here, yesterday we talked about, let's see yeah, yesterday we found out that the U.S. economic growth rate unexpectedly declined in the first quarter by 1.4%. Sadly, the data that I had would have suggested that, and I knew that I had this data 5 days ago before this was even released. So, and again, I have data from hedge funds that I pay to get this data, and we parcelate it, and we essentially bring it down to our brain machine, and we're slowly going to be compounding that. But let's talk about this data, right? So here's a laser so you guys can see, right? So if you look at, I know, right? Exactly. Unexpectedly, it's very funny because it's like, well, really unexpectedly. I can tell whoever wrote that leaned in a very particular political inclination. But as you can see here, big money bulls have dropped off, okay? And, while essentially we are kind of optimistic when people are pessimistic, when big money bulls drop off, we become pessimistic, even the most contrarian investors like myself. Reason why is these people have the money to prop up the stock market. And if they're not putting money in, then it's not looking good for the short term. And I have data, again, that extends back. Again, it's all about historical data and trends and all that. Now, if you look at it, they were really optimistic back here in October, about 50%. But if you look at this reading, it is the second lowest reading compared to 2020 in the survey's history, which is extremely very worrisome because this extends back to 1999, and it extends to the dot-com bubble crash, and it extends to the 2008 financial crisis. So big money is stepping out, and sadly, we unfortunately may have ended the bull run. And who knows, we may currently be in a recession and we may not know it yet until the next unexpected, decline happens. And then that's a full-fledged recession. Okay. Now, President Biden says, it's not going to happen until 2023 after the elections. The way they preface it, it's like, come on, man, do we really care? It's both sides. They care more about votes. Anyhow, let's leave politics out of this. Only if it affects the stock market, which in this case it does, but that doesn't need to have commentary. I think that's annoying, don't you? All right. So if you look at the big money sentiment, just more specific, because first we looked at the big money bulls, and it's dropped from 50 to 33. Okay. If you look at the bull percentage to bear, you can see that we went from a ratio of 38 down to 11, which means that bulls are running the show. Again, let me just be clear. This is the second lowest rating in 23 years. So in 23 years, if you look at this data from the biggest investors, we're talking the freaking people that you guys, we don't know about, the creme de la cremes, the freaking Wall Street billion-dollar people that you only hear about when they're in, they go to jail or they F up the financial crisis like the Lehman Brothers, right? They're leaving the market now, all right? So understand that. So now, again, they're not leaving the market forever. Come on, it's not like, they're breaking up from me forever. No. If you combine, now you might ask me, okay, well, how does this relate to the stock market? Like how does this bull ratio affect us? Well, we have that data. Okay, so if you compare the S&P 500 returns to the surveys at Barron's from the big money, least money, most bulls, right? All that, you can see here there's two columns. Okay, column 1, column 2. Column 1 is least bullish surveys. Column 2 is the most bullish. Now let's focus on the least bullish, the bearish, because that's what we're in right now. If you kind of, there's a lot of numbers here. Don't worry. Just go all the way down here and look at the average return. It's negative 1.1%. And unfortunately, 55% of the time, they were actually positive, which means that every time these people are the least bullish, it tends to pan out that the stock market is going to be stagnant for a while. Okay. And we'll go into it, but just a quick 6 months, right? So now if you look at the most bullish surveys, you can see that we get an average return of 7.3%, 83% of the time, which is why they say average return for the S&P is 7%, right? If you invest in stocks, you want to 7%. All right, so if you look now we're going to switch gears, okay? Not from a different indicator. We're going to look at now the Philadelphia Federal Reserve's monthly manufacturing survey. Now, again, people are like, what the heck is this? Now, in the Mastering Stock Market course, we will be talking about these. You're going to walk out and you're going to essentially, if you want to apply for a PhD in economics so you can go on CNBC and talk about these things, you guys can do that, right? But again, most of those economics people are detached from stocks. They don't know how to evaluate stocks. They get too delved into the economics. There needs to be a certain balance. But this is important, especially when you have readings this low, okay? So again, the Philadelphia Federal Reserve monthly manufacturing survey targets CEOs, and essentially it's conducted in the first week of each month and released on the third Thursday. So what we found is, so one of the survey's components is the 6-month forecast for new orders, which is important. We want to know new orders for the next 6 months, right? So this basically gives you insights of how a potential future business plan is going to recapitulate. We already saw in the Apple's earnings that they're saying that there's going to be a slowdown in June. Okay, sorry for my hands, but this is how I teach, okay? So now when the Philadelphia Fed 6-month forecast for new orders falls below 5%, which we see right here, right there, okay? The survey suggests that CEOs are concerned about the future outlook for growth in the manufacturing sector. Again, how does this affect the stock market? Well, if people are not producing as much, then they're not selling as much, which will affect the corporate earnings. And if wage increases are increasing because inflation, and then the company is not able to basically pay their workers because they're not making the right revenue and shareholders pull out, people are going to end up basically letting go of their employees, and then we're slowly heading into a recession, and we're already starting to see different companies start cutting and closing offices. Okay, so so this setup that we're seeing, unfortunately, as I said, bleeds into other baskets of economic indicators that you are going to see in the future, like the economic indicator that we saw yesterday. Okay, so and what this basically tells you is that if you look at the S&P 500 sectors and industries, it suggests that we should be cautious because we're going to get in a low return environment for the next 6 months. So I want to hold. Sorry for going back and forth. I want to make sure I get every slide for you guys. So why do we care about the Philadelphia, the Fed 6-month forecast? Well, the bigger one is the ISM Manufacturing Index. Now, that's the big one. That's the indicator that we all look at. But there's a way to predict that indicator that businesses look at by looking at the Philadelphia. So it's almost like there's an indicator that Wall Street people use, but we're smart. There's another indicator that helps predict that other indicator. And some of these people don't know about this. And I'm telling you what that is, if that makes sense. So the ISM Manufacturing new orders after the Philadelphia Fed 6-month forecast for new orders crosses below 5%. You can see once we get that hit, we get a drop. We got a signal, drop. Signal, drop. Signal, drop. So as you can see, this is a pretty predicting manner, okay? In fact, let's go back when it does cross 5%. You can see the last time it did that was the 2008 recession. Look at that big drop there. It was literally the 2008. Then you go back, 1994, 1990, 78, right here. These are like, some of them are hitting mini recessions there, okay? So I hope this is very helpful, okay? So now you might say, okay, Al, I understand the Philadelphia, the Fed 6-month forecast. Okay, I understand the ISM. How does that affect the freaking stock market? Well, here it is. Every time the S&P 500 after the Philadelphia Fed 6-month forecast new orders crosses below that 5%, here's the 1 week after that, 2 weeks after that, a month, 2 month, 3 month, 6 month. That's why in Al Stock Alerts and Mastering Stock Market course, we like to cater to long-term investors and also short-term investors and swing traders. So for the day traders, this is actually good because it tells you without a doubt that maybe the first 1 to 2 week, if there's a 70% chance that it's going to be positive, but then as we bleed out, we are going to get some stagnant returns. As you can see, every time we hit this new orders crossing below 5%, you can see the stock market tends to go down, right? So we may be in for another downturn, which is why a lot of money managers are probably informing people, hey, you should take a look at it. But again, dollar cost average is the way to go because, I got to talk about that study again. So we'll talk about that. But then now we got to split that. How does this affect Clover Health? How does this affect my portfolio? Well, the sectors and industries that you guys need to be a little cautious about are financials and technologies. Those are the ones that you need to pay attention to because the financials are essentially, there's a big drop here, okay? And if you look at technologies, it also has a very stagnant feel because of all the issues that we're experiencing with the generation of, let's say, particular products. Now, what's interesting here is healthcare. Clover's sitting in a very weird position where it doesn't really get hit that hard, but it's also a technology company. So that's something to keep in mind. Clover's been hit so hard, but if it does get lower, understand the stock is different than the actual fundamentals of the business. And over time, the stock will transcend to that particular value. Okay. So let me remove this so we can all hear. So I'm trying to see. I think this is it. Yeah. So last but not least, I believe this is the last day for Webull. Yeah, today or two. Yeah, so pretty much we're in the last hour. Usually Webull gives out 2 free stocks. However, their promotion ends literally within the next 24 hours. They're giving out 5 free stocks valued up to $9,600. All you got to do is deposit 1 penny. I mean, 1 penny to get 5 free stocks. Also, it's actually a really good platform too. They have a good community, comment sections, great indicators. So here is the link. It'll be in the description box below. But for people that are interested, I also went ahead and pinned it down in the comment sections in the live if you're watching. So, so just a quick some housekeeping updates. I hope that was a lot of information. You may have to rewatch that a couple times. That was a lot of data. But my YouTube studio is being set up. It's going to be really good, right? So this is like I have a whiteboard back here. Kind of do my economic thinking projections and all that stuff to kind of understand the economy. But I do have a beautiful room for you guys for the YouTube. It's taking me time to build. Yeah, that's all I have for you folks. It's a privilege and honor. Make sure I keep forgetting. So you subscribe, like, and also comment what you think about everything that I discussed. I want to hear your feedback. You know what I mean? I don't want to just kind of be like talking and echo. I want to hear from you guys, right? It's like YouTube is a community. So comment down below and make sure you like it because apparently it helps with this algorithm, the YouTube. So it helps spread the video. So yeah, that's a lot of people have been telling me to say those things, so I just remembered. So there it is. But anywho, I'll see you guys on the next one, and I got to get going. Oh my God! But yeah, so don't worry, and there's a lot of some bearishness here, but it's going to give you opportunity to buy the dip. Okay, and for my TDOC people. Actually, let's go here. For people that were in TDOC, I'm going to make another video for that later on. But if you can see here, if you look up ARK, and this is directly from our Discord, you can see that Kathy Woods bought a lot of TDOC here, and she bought more here, and she bought again here. She bought a lot. She bought so much TDOC. She went from having a 7% ownership in TDOC to a 13% ownership in TDOC for her weighted portfolio here, right? So this is pretty cool. So we did a price target on TDOC. It does look like another Tesla. All right. Or like maybe half of a Tesla, which is still damn good. All right. Thank you for all the education you give us. Keep up. Hey, I really appreciate that, man. Yeah, it's definitely it's sad because you got to pay a lot of money to get this data. This is very expensive data, and it's sad because retail doesn't have this. So it's good to democratize financial information. We actually have this amazing platform here, and it's really democratizing. It's making so many people money. In fact, here, if you look at it, the results speak for themselves. We have a lot of people. These are the testimonials, and also all the people making money. Literally, they're just making thousands of dollars every week. So I'm very proud of them. Continue doing the hard work. Never give up. And yeah, I'll see you guys in the next one. Peace.